In the world of trading, the illusion of quick success is one of the most seductive traps the human mind can fall into. It begins innocently, a few videos, a couple of stories, a handful of screenshots, showing people turning small accounts into fortunes. The brain, wired to seek shortcuts to reward, locks onto this vision like a predator sensing prey. Dopamine floods the system, and a trader is born not from discipline or understanding, but from desire. The desire to experience success fast, without enduring the grind that true mastery demands. This illusion doesn't form overnight. It's the result of subtle conditioning. Every piece of trading content, every advertisement, every influencer post showing profits creates an internal narrative that success in trading is accessible, immediate, and repeatable. The unconscious mind begins to believe that trading is merely about finding the right strategy or the perfect setup. The truth, however, is that trading is a psychological arena where speed kills, not the speed of execution, but the speed of expectation. The faster you expect results, the faster disappointment corrodes your mindset. When traders start, they often experience something that psychologists call the beginner's luck bias. It's a random coincidence where initial trades work out positively. The market doesn't reward them for skill. It rewards them by chance. But the emotional reaction to that chance success is deeply deceptive. It anchors the brain to the belief that success is just around the corner, that the market is easy, and that consistency will arrive in a few more trades. This early reinforcement builds false confidence, and false confidence leads to over-leverage, over-trading, and an inflated sense of control. It's at this exact point that the illusion becomes dangerous. The trader begins to mistake randomness for mastery. The human brain, when it tastes success early, forms what neuroscientists call a reward prediction error. Essentially, the brain starts predicting the next reward before it happens. Each profitable trade builds a mental pathway of expectation, and when that expectation isn't met, the emotional backlash is severe. A losing trade, after a streak of wins, doesn't just hurt financially. It violates the brain's prediction model. This creates cognitive dissonance, a state where reality doesn't align with belief. The trader now faces an internal war, the desire to believe in the illusion, versus the painful awareness that it might have been false all along. Most people can't handle this conflict, so they either double down on reckless behavior or give up entirely. This illusion is further amplified by the modern world's obsession with speed and instant gratification. Every aspect of life, from food delivery to social validation, happens instantly. People have been conditioned to equate speed with success. Trading, on the other hand, is the opposite of instant gratification. It's delayed feedback, delayed results, and delayed understanding. The market tests patience more than skill. The slow pace of real progress collides violently with the trader's internal timeline, creating frustration, doubt, and impatience. The mind whispers, if others can do it fast, why can't I? That question becomes the beginning of a psychological unraveling. What most new traders fail to understand is that the market rewards emotional maturity, not mechanical repetition. A strategy might take minutes to learn, but the temperament to execute it flawlessly under pressure takes years to develop. This gap between knowledge and behavior is where most traders crumble. They know what to do, but can't do it when it matters. This is not a lack of intelligence, it's a lack of emotional conditioning. The illusion of quick success prevents them from accepting that emotional conditioning cannot be rushed. It's built slowly through failure, reflection, and self-awareness. The illusion is also strengthened by social comparison. Humans are social creatures. Our sense of progress often depends on how we perceive ourselves relative to others. In trading communities, online forums, and social media platforms, everyone seems to be winning. People rarely share their losing days, their anxiety, or their years of grinding without returns. The brain, bombarded with curated success, begins to distort reality. It starts to believe that struggling is abnormal, and that everyone else has figured it out. This comparison amplifies insecurity and creates a sense of urgency, a need to catch up. But in trading, speed driven by insecurity leads to destruction. The illusion doesn't just create unrealistic expectations, it rewires motivation. Instead of being motivated by curiosity, growth, or long-term mastery, Traders become motivated by the need to escape discomfort, the discomfort of not winning yet. This is known in psychology as avoidance motivation. It's the type of drive that makes people chase quick results to avoid feelings of inadequacy. Unfortunately, avoidance motivation is inherently unstable. When the results don't arrive quickly, the motivation collapses. The trader loses interest, confidence, and eventually persistence. The deeper layer of this illusion lies in the human misunderstanding of probability. Trading is a probabilistic game. Even a perfect strategy will have losing streaks. But beginners approach it as a deterministic one, believing that if they follow the rules perfectly, the outcome must be positive. When it isn't, the illusion shatters. The trader doesn't interpret the loss as statistical variance. They interpret it as personal failure. This misinterpretation creates emotional instability and erodes trust in the process. The illusion of quick success teaches traders to focus on outcome, not process. The market, however, only rewards those who can detach from outcomes and stay grounded in process. There's also a biological element at play. Dopamine, the neurotransmitter responsible for motivation and reward, spikes when the brain anticipates pleasure, not when it receives it. The illusion of quick success keeps dopamine levels high through constant anticipation. Every chart pattern, every entry signal, every potential breakout stimulates that same circuit of anticipation. But when reality doesn't deliver consistent pleasure, when profits don't flow as expected, dopamine crashes, leading to demotivation and emotional fatigue. It's not the market that drains traders. It's the emotional roller coaster of unmet expectations. Another reason the illusion persists is because of how people define success. In trading psychology, success is not defined by winning trades, but by emotional stability, consistency, and resilience. Yet most traders, influenced by societal conditioning, equate success with financial results. This narrow definition fuels impatience, because money becomes the only metric that matters. When the account balance doesn't grow fast enough, the trader assumes failure, not realizing that internal growth, the ability to manage fear, accept uncertainty, and remain disciplined, is happening invisibly beneath the surface. The illusion of quick success is also a coping mechanism. Many traders come to the market seeking more than money. They seek identity, freedom, and validation. The idea of fast success satisfies these unmet psychological needs. It provides a fantasy where they're no longer ordinary, no longer powerless, no longer unnoticed. The market becomes a mirror reflecting who they want to be. But when that mirror cracks, when the market exposes flaws, impatience, and emotional weakness, it creates an identity crisis. The trader isn't just losing trades. They're losing the version of themselves they wanted to believe in. Over time, this illusion leads to emotional burnout. The constant cycle of hope, excitement, failure, and frustration becomes mentally exhausting. Traders start to lose trust, not just in the market, but in themselves. Their self-talk changes from, "I can do this," to "maybe I'm not built for this." This is where most traders quit. But what they're really quitting isn't trading. They're quitting the illusion that success should have come faster. They never gave themselves the chance to see what was possible beyond the illusion. Psychologically, this phase is similar to what athletes call the dark zone, the part of training where improvement slows down, where progress feels invisible, and where mental endurance is the only thing that matters. In trading, this dark zone comes after the initial excitement fades, and the harsh reality of uncertainty sets in. Those who entered the market chasing a fantasy of quick success never survive this zone. They interpret struggle as a signal to stop, rather than a necessary stage of transformation. The mind resists slow growth, because slow growth lacks visible feedback. The brain wants evidence of progress, a dopamine reward for effort. But trading often provides none. You can do everything right and still lose. You can spend weeks studying and still feel lost. Without understanding that this ambiguity is normal, traders internalize it as failure. The illusion of quick success blinds them to the truth that the market is not a sprint. It's an arena for mastering the self, and mastery by nature is slow, uncertain, and deeply uncomfortable. To dismantle the illusion, one must understand that every great trader, every consistent performer, went through a long phase of psychological disintegration before they rebuilt themselves with patience and acceptance. But the illusion tells beginners that such suffering is avoidable, that there's a shortcut, a strategy, or a secret that skips the pain. The reality is that the pain is the path. The emotional chaos, the losses, the confusion, these are the raw materials of growth. Without them, emotional resilience never develops. The illusion of quick success feeds on impatience, and impatience is a form of fear. Fear that maybe you'll never get there. Fear that you're wasting time. Fear that you're not enough. This fear drives people to chase new systems, new mentors, new methods, hoping that external changes can create internal stability. But no strategy can compensate for psychological unpreparedness. The trader's real enemy is not the market, but the illusion of who they think they should already be. Ultimately, this illusion creates a paradox. The more traders chase fast success, the further they move from it. True success in trading only begins when one stops chasing it, when one surrenders the need for immediate gratification and embraces the slow, often invisible process of psychological transformation. The illusion promises power and freedom, but it delivers frustration and defeat. Only when the trader stops believing in quick success can real progress begin, though most never reach that realization, because the illusion feels safer than the truth. In trading, people often talk about volatility as something that exists on the charts. Price swings, market spikes, unpredictable movements, and sudden collapses. But the most destructive volatility doesn't occur in the market. It happens inside the trader. Emotional volatility is the silent storm that shapes every decision, every hesitation, and every loss. While traders prepare to face market uncertainty, few are ever prepared to face the unpredictability of their own emotions. The irony is that most traders believe they're battling the market, when in truth, the market is only a mirror reflecting back their internal chaos. At its core, emotional volatility is the inconsistency of one's internal state. It's the inability to maintain emotional equilibrium under pressure. The market, with its constant flow of uncertainty, triggers primitive parts of the brain that are hardwired for survival, not rational decision-making. When prices move against a position, the amygdala, the brain's emotional alarm system, interprets it as a threat, similar to how our ancestors reacted to physical danger. The stress hormone cortisol floods the bloodstream, heart rate increases, and decision-making shifts from logical to reactive. The trader's world collapses from analytical awareness into impulsive survival instincts. The brain's natural reaction to loss is panic, and panic manifests as impulsive behavior. In this heightened emotional state, traders often break their rules, close trades too early, revenge trade after losses, or over-leverage to recover faster. The illusion of control shatters, and the trading plan, the carefully constructed framework of logic, becomes irrelevant. What's left is raw emotion dictating every move. Emotional volatility doesn't just destroy accounts. It destroys the trader's relationship with themselves. It erodes trust, confidence, and the sense of control that once made trading exciting. Emotional volatility is intensified by an internal conflict that exists in every trader. The clash between two psychological systems, the rational mind and the emotional mind. The rational mind seeks consistency, structure, and long-term growth. The emotional mind craves instant relief, validation, and certainty. When these two systems collide under pressure, the emotional mind almost always wins because it operates on survival energy. A losing trade doesn't just represent money lost, it represents ego injury, identity threat, and the fear of failure. The trader's self-worth becomes entangled with performance, and every red candle feels like personal rejection from the universe. Over time, this emotional roller coaster becomes exhausting. Traders who once felt calm and confident begin to experience psychological fatigue, a condition where the nervous system becomes hypersensitive to every fluctuation. Even small losses start to trigger exaggerated emotional responses. The constant cycle of hope and despair turns trading into an emotional addiction. Just like a gambler, the trader starts chasing the next dopamine hit from a winning trade, but each win feels shorter and less satisfying. The losses, however, feel deeper and more painful. This imbalance between emotional reward and punishment leads to burnout, self-doubt, and impulsive decision-making that sabotages consistency. The paradox is that traders often blame the market for this instability. They say the market is manipulated, unpredictable, unfair, but what they're really experiencing is their own inability to regulate emotion under pressure. The market doesn't target anyone. It simply moves. It's indifferent, immoral, and mechanical. The emotional reaction we project onto it is entirely human. The market becomes the stage where the trader's deepest fears of loss, inadequacy, and lack of control play out in real time. Every tick becomes a psychological trigger. Every fluctuation a test of emotional maturity. One of the greatest psychological fallacies in trading is believing that more knowledge will reduce emotional volatility. Many traders respond to emotional chaos by consuming more information, more indicators, more systems, more data. But emotional instability isn't caused by a lack of information. It's caused by a lack of self-awareness. The trader doesn't need more strategies. They need more control over their state of mind. Knowledge can sharpen skill, but it can't stabilize emotion. The deeper truth is that emotional volatility stems from the gap between intellectual understanding and emotional acceptance. You can understand that losses are part of the game intellectually, but if your nervous system still reacts to losses as threats, your behavior will always betray your knowledge. The problem is that trading demands emotional neutrality, but humans are not neutral creatures. Every human decision is influenced by emotion. Even decisions that appear logical are driven by emotional undercurrents. The trader who thinks they're being rational after a loss is often unconsciously trying to escape the emotional pain of being wrong. This is why most traders repeat the same mistakes over and over, even after recognizing them. Awareness doesn't automatically lead to control. Emotional regulation requires conditioning. The mind must be trained, not taught. The essence of emotional volatility lies in attachment. Traders become attached to outcomes, to being right, to winning, to validation. Each attachment becomes a psychological anchor, and when the market pulls against it, emotional tension builds. The tighter the grip, the stronger the pain. This attachment is also rooted in ego. The ego can't tolerate being wrong because being wrong threatens its identity. So when the market proves it wrong, the ego retaliates with denial, blame, and revenge. The trader re-enters the market not to trade objectively, but to restore their damaged sense of self. And in doing so, they lose even more. This cycle of emotional volatility mirrors addiction psychology. Each emotional high and low reinforces a behavioral loop in the brain. The trader becomes conditioned to chase the next emotional hit rather than logical outcomes. The nervous system becomes dependent on stimulation, and when the market is calm, the trader feels restless. They start forcing trades just to feel alive. Over time, trading stops being about profit and becomes about emotional escape. The trader isn't trading to win, they're trading to feel something. This emotional dependency is dangerous because it rewires the trader's sense of normalcy. Constant stress becomes the baseline. Calmness feels unfamiliar, even uncomfortable. When the market slows down, the trader feels anxious because their brain has become addicted to the chaos. The body is flooded with adrenaline and cortisol daily, leading to chronic tension, fatigue, and decision paralysis. The trader's mind becomes foggy, and what once felt like a clear, rational craft now feels like an uncontrollable battle against invisible forces. Emotional volatility also creates cognitive distortions. When under stress, the human brain interprets reality through fear and bias. A small market fluctuation suddenly feels catastrophic. A minor loss feels like proof of incompetence. A missed opportunity feels like a personal attack from fate. These distortions create a warped perception of reality, where logic no longer operates effectively. Traders begin to see patterns that don't exist, interpret randomness as conspiracy, and take trades not out of conviction but desperation. Emotional volatility, in essence, blinds the trader from the truth of the market, that it's neutral and impersonal. The irony is that the more emotionally volatile a trader becomes, the less capable they are of recognizing it. Emotional erosion narrows perception and suppresses self-awareness. The trader in emotional turmoil doesn't know they're irrational. They believe they're making sense. This creates what psychologists call the illusion of control, where the trader believes that their emotional reactions are justified responses to market conditions. But the market isn't doing anything personal. The reaction is self-generated. The lack of awareness of this fact traps the trader in a feedback loop of suffering. True trading psychology isn't about eliminating emotion, it's about understanding it. Emotions carry valuable information. Fear can protect you from reckless decisions. Frustration can signal unmet expectations. But when emotions dominate behavior instead of informing it, they become destructive. Emotional volatility happens when emotions are not observed, but obeyed. The difference between a professional and an amateur is not who feels less emotion, but who is less controlled by it. The core driver of emotional volatility is uncertainty. The human mind craves predictability and structure, but the market offers none. Every trade is a step into the unknown, and this constant uncertainty creates psychological discomfort. People naturally seek to escape discomfort, which is why traders rush into impulsive actions, closing trades early, moving stop losses, or flipping strategies. These actions are not rational. They are emotional escapes disguised as decisions. The inability to sit with uncertainty without reacting is what separates those who endure from those who quit. Over time, emotional volatility damages the trader's sense of identity. They begin to question their competence, intelligence, and even worth. The emotional highs of winning feel euphoric, but the lows of losing feel existential. The emotional range becomes extreme, swinging from confidence to despair, from belief to hopelessness. The trader's internal dialogue turns toxic. Why do I keep doing this? What's wrong with me? Maybe I'm not cut out for this. This self-criticism feeds further emotional instability. The trader starts associating trading not with growth, but with pain. The worst part is that emotional volatility doesn't just stay in the charts. It seeps into daily life. Traders carry their emotional residue outside the market. They become irritable, distracted, or numb in their personal lives. Relationships strain, sleep quality declines, and mental clarity fades. What began as a passion for freedom and mastery slowly transforms into psychological imprisonment. Emotional volatility becomes the invisible leash that pulls traders away from both financial and personal stability. Many traders believe that controlling emotion means suppressing it, but suppression only intensifies volatility. The energy of suppressed emotion doesn't disappear. It builds beneath the surface until it erupts at the worst possible moment. True emotional control comes from acknowledgement, not denial. It's the ability to witness one's feelings without judgment, to recognize fear without becoming fearful, to feel greed without acting on it. This level of emotional intelligence requires deliberate practice, journaling, mindfulness, reflection, and detachment. Yet few traders invest in emotional training because it doesn't offer immediate results. And as long as quick results remain the focus, emotional volatility remains the companion. In psychological terms, trading is one of the most emotionally demanding activities a human can engage in, because it combines uncertainty, risk, and self-judgment. Every trade is a mirror reflecting back the trader's level of emotional maturity. The market doesn't punish or reward. It reveals. When traders say the market humbled them, what they mean is that it exposed their emotional fragility. Emotional volatility is not a flaw. It's a signal pointing to areas where emotional growth is needed. The problem is that most traders interpret this signal as failure rather than feedback. The market's volatility is measurable. Emotional volatility is not, but it's the latter that truly determines whether a trader survives long enough to find consistency. The market's ups and downs can be navigated with skill, but the turbulence within one's own mind requires something deeper: awareness, patience, and emotional discipline. Most traders prepare to fight the market, yet the real fight is always internal. The battle is not against price movement, but against one's own impulses, fears, and expectations that arise in response to it. In trading, uncertainty is not just a condition of the market, it is the fundamental law that governs it. Every price movement, every setup, every decision unfolds in an environment where nothing is guaranteed, and everything is subject to change. Yet, while uncertainty is inherent to the craft, the human mind is biologically wired to avoid it. The brain seeks patterns, predictability, and a sense of control. It thrives on knowing what comes next. When confronted with the randomness of the market, this wiring becomes a psychological liability. The result is emotional discomfort, so deep that it drives most traders to abandon the process before they ever adapt to it. The pain of uncertainty stems from the brain's survival mechanisms. For thousands of years, Uncertainty was associated with danger. In ancient times, not knowing what was behind the bushes could mean death. Today, not knowing what the next candle will do triggers that same primal response. The amygdala, which governs fear and emotional reactions, cannot distinguish between physical threat and financial threat. When a trader sees their position move against them, their brain reacts as if they are under real attack. Heart rate spikes, breathing quickens, and cortisol floods the body. The trader's ability to think logically diminishes. In this physiological state, clarity is replaced with panic, and patience is replaced with impulsive decision-making. What makes this pain even more intense is that the market constantly teases the illusion of certainty. Charts appear to form patterns, indicators seem to predict outcomes, and price action occasionally aligns with expectation. Each of these moments reinforces the false belief that certainty can be achieved with enough analysis or the right strategy. But as soon as the trader believes they've found certainty, the market shifts. This pattern of hope and betrayal repeats endlessly, conditioning the mind into a cycle of frustration and confusion. The trader becomes trapped between two realities, the desire for control and the truth of chaos. The discomfort caused by uncertainty is not merely emotional, it's existential. The human ego wants to believe it can control outcomes through effort and intelligence. In most professions, this belief holds true. More skill, more predictable results. Trading violates this principle entirely. A trader can make perfect decisions and still lose money. They can do everything wrong and still make a profit. This disconnect between process and outcome shatters the illusion of cause and effect that most people rely on for stability. When the link between effort and reward disappears, the ego feels powerless, and powerlessness breeds anxiety. Traders often respond to uncertainty by overanalyzing. They drown themselves in data, backtests, and endless chart patterns, believing that more information will reduce the unknown. But information doesn't eliminate uncertainty, it amplifies it. The more variables a trader introduces into their mind, the more room there is for doubt. Analysis becomes paralysis. Every potential trade feels both right and wrong. Every decision carries a hidden fear of regret. The trader becomes mentally exhausted, and exhaustion makes uncertainty feel heavier than it is. The pain of uncertainty is also intensified by temporal distortion, the brain's inability to perceive time accurately under stress. In a losing position, minutes feel like hours. The uncertainty of not knowing whether a trade will recover or collapse stretches time into unbearable lengths. This creates psychological torture. Traders try to escape the discomfort by closing trades prematurely or flipping positions impulsively. But each act of escape reinforces avoidance behavior, teaching the mind that uncertainty is something to be escaped, not endured. The more a trader avoids uncertainty, the less tolerance they build for it. Tolerance for uncertainty is the real currency of trading psychology. It determines how long a trader can stay objective under pressure, how calmly they can execute amid chaos, and how detached they can remain from outcomes. But developing this tolerance requires sitting in discomfort long enough to learn that uncertainty isn't a threat. It's simply reality. Most traders never reach this stage because the pain feels unbearable. They crave certainty so intensely that they sacrifice good decisions just to relieve tension. In doing so, they abandon logic for comfort. And comfort is the death of growth. The human mind seeks closure, a concept known in psychology as the Zeigarnik effect. Unconsidered experiences create mental tension that demands resolution. Every open trade represents an unresolved outcome. The trader's mind obsesses over it, checking the charts repeatedly, unable to rest until it's closed. This constant mental engagement magnifies uncertainty into obsession. The trader stops analyzing objectively and begins reacting emotionally to every tick. Their nervous system becomes hyper-attuned to the slightest movement, interpreting each fluctuation as a signal of safety or danger. Over time, this hypervigilance leads to emotional exhaustion. Uncertainty also challenges the illusion of self-control. Traders enter the market believing they can manage risk, follow rules, and remain composed. But uncertainty exposes the limits of control. No amount of discipline can remove randomness from outcomes. This realization creates an internal contradiction. The trader must act decisively in a world where no decision is ever certain. The mind struggles to reconcile this paradox. Some traders freeze, paralyzed by indecision, while others swing to the opposite extreme, overtrading in an attempt to force clarity through action. Both reactions are symptoms of the same discomfort, the refusal to coexist with the unknown. The pain of uncertainty is particularly destructive because it activates the same psychological circuitry as loss. Even before a loss occurs, the fear of it creates the same emotional suffering. This anticipatory anxiety drains mental energy and erodes confidence. A trader can lose focus not because of an actual drawdown, but because of the constant anticipation of one. The body remains in a state of chronic stress, waiting for disaster that may never come. This state of hyper-alertness prevents rational engagement and reduces creativity, the two traits most necessary for adaptive decision-making in dynamic markets. Uncertainty also reveals the trader's relationship with control. Those who equate control with safety struggle most. They view unpredictability as personal failure, interpreting market randomness as proof that they are not skilled enough. But the market doesn't measure intelligence or effort. It measures emotional adaptability. The trader who can remain centered amid uncertainty, who can hold positions without panic and let time unfold, is not fearless. They're simply trained to tolerate ambiguity. That tolerance doesn't come from knowledge, but from experience, from surviving enough storms to realize that not knowing is not the same as being unsafe. The inability to handle uncertainty also manifests in traders' need for validation. They seek reassurance from others, constantly questioning their methods, hopping between strategies, and chasing external confirmation. This dependency weakens internal trust. When uncertainty arises, instead of relying on their own process, they look outward for answers, to mentors, analysts, or online groups. But no one can give certainty where it doesn't exist. Each piece of external advice creates more conflict, and the trader's internal voice grows quieter. Eventually, they lose faith not just in their strategy, but in themselves. Psychologically, uncertainty magnifies self-doubt. When outcomes are unclear, the mind fills the void with stories, narratives that justify or condemn. Traders replay past mistakes, fear future failures, and question their competence. The uncertainty outside becomes uncertainty inside. This internalization leads to identity conflict. Am I a good trader? Am I even cut out for this? The mind, desperate for resolution, convinces itself that quitting will restore peace. And so, many traders don't leave because of losses. They leave because the uncertainty of not knowing when success will come becomes unbearable. Uncertainty is also deeply connected to ego. The ego thrives on predictability because predictability validates identity. When things go as expected, the ego feels powerful. When they don't, it feels threatened. The market constantly humiliates the ego by refusing to conform to its expectations. Every unexpected move is an ego wound, and each wound fuels emotional resistance. Instead of adapting, the trader fights reality. They argue with the charts, justify bad trades, and seek revenge against randomness. But the more they fight uncertainty, the stronger it becomes, because resistance amplifies the very emotion it seeks to suppress. What most traders fail to understand is that uncertainty is not a problem to be solved, but a condition to be accepted. The moment a trader stops trying to eliminate uncertainty and instead learns to navigate within it, everything changes. But this level of acceptance requires a deep shift in perspective, from control to flow, from prediction to adaptation, from fear to observation. It requires psychological maturity that comes only through repeated exposure to chaos without reacting destructively to it. The pain of uncertainty, at its core, is the pain of letting go. Letting go of control, of perfection, of the illusion that success follows effort in a straight line. It's the pain of surrendering to a process that cannot be tamed or predicted. Those who cannot bear this pain look for shortcuts, new systems, or external saviors. Those who can sit with it, breathe through it, and continue to act rationally in its presence, slowly transform their relationship with the market. Uncertainty stops being an enemy and becomes an ally, a reminder that anything is possible, and that mastery is not about predicting the future, but about managing oneself in the face of not knowing. One of the most underestimated psychological barriers in trading is the lack of identity shift. Many traders enter the market with the mindset of an employee or a student. People who are accustomed to structured environments, clear hierarchies, and predictable cause and effect relationships. They expect consistent results for consistent effort, steady progress for hard work, and recognition for performance. The trading environment violates every one of these assumptions. The market doesn't care about effort, time, or intention. It only responds to behavior and probability without a fundamental shift in identity, from that of a results-seeking worker to a process-driven risk manager. Traders remain trapped in mental frameworks that guarantee frustration and failure. The employee mindset is built on the illusion of control and reward predictability. You show up, do your job, follow instructions, and at the end of the month, you receive a paycheck. This structure creates psychological safety. The mind associates consistency with competence, but in trading, the same consistency doesn't exist. You can do everything correctly for days and still lose money. You can break your rules and be rewarded temporarily. The link between behavior and outcome becomes blurred, and this ambiguity threatens the trader's sense of identity. The human mind, accustomed to linear reinforcement, cannot process randomness without psychological distress. This distress manifests as emotional conflict. The trader's old identity, the one that equates effort with reward, clashes with the reality of probabilistic outcomes. When the market delivers losses despite disciplined behavior, the trader feels betrayed. They begin to question their abilities, their strategies, and their worth. But the real issue is not their performance. It's their perspective. They're still operating under an identity that was never built to handle chaos. Trading demands an identity that thrives in uncertainty, that finds validation in execution, not results, and that accepts loss as a natural byproduct of progress. Without this identity shift, traders remain emotionally reactive. They take losses personally, feel shame after mistakes, and experience pride after wins. This attachment to outcomes turns trading into an emotional pendulum. The mind swings between euphoria and despair, constantly seeking confirmation of self-worth through market results. The more they attach identity to outcomes, the more unstable they become. Consistency cannot exist where self-worth fluctuates with every tick. The lack of identity shift also explains why traders struggle to follow rules they consciously understand. They know they should manage risks, wait for setups, and stay disciplined. Yet they repeatedly break their own guidelines. This isn't a lack of knowledge, it's a conflict of identity. The old self, the one that seeks certainty, comfort, and immediate validation, hijacks behavior in moments of stress. True change in behavior can only happen when the identity itself changes. A trader must stop thinking like someone who expects security and start thinking like someone who manages probability. Until that shift happens, emotional impulses will always override rational plan. Identity also dictates how a trader interprets feedback. An employee sees feedback as evaluation. Good performance equals approval, bad performance equals criticism. In trading, feedback comes in the form of market response. A losing trade isn't criticism, it's neutral information. But without the identity of a trader, losses are internalized as judgment. The ego interprets them as proof of incompetence. The trader then reacts emotionally, trying to fix themselves or the market, rather than analyze data objectively. This emotional distortion prevents learning. The trader becomes obsessed with being right, instead of becoming better. A deeper aspect of the identity problem lies in self-concept rigidity. People enter trading with fixed beliefs about who they are: intelligent, hardworking, logical. When the market challenges these beliefs by punishing them despite effort, the mind resists adaptation. The ego clings to the old identity because changing it feels like self-erasure. Admitting that your current self is unfit for the game requires humility that few possess. Most traders would rather protect their ego than transform it. They'd rather rationalize failure than face the discomfort of identity death. But transformation always requires death, the death of who you were. The trader identity cannot coexist with the old self. It must emerge through the destruction of comfort, the dissolution of certainty, and the rebuilding of mental frameworks. The successful trader's identity is not rooted in outcomes, but in adaptability. They no longer seek to be right. They seek to respond effectively. They don't crave comfort. They crave clarity. Their self-worth is detached from performance, because they've learned that results fluctuate, but character remains. This shift also changes how time is perceived. The employee mindset measures time in hours worked and productivity achieved. The trader mindset measures time in exposure, patience, and experience. In the old paradigm, effort is rewarded immediately. In the trading paradigm, effort compounds invisibly. The trader must act with long-term detachment, trusting that discipline pays off in ways that cannot be measured in the short term. Without the identity of patience, the old self will always interfere, pushing for quick gratification and sabotaging consistency. Another crucial difference between the old identity and the trader identity lies in responsibility. Employees share responsibility with systems, supervisors, and teams. Traders, however, are completely alone. Every mistake, every loss, every decision is theirs. This level of accountability is psychologically intense. The old self resists it because it exposes vulnerability. There is no one else to blame, no structure to hide behind. The lack of identity shift leaves traders psychologically unprepared for this solitude. They seek external validation, blame the market, or look for gurus to follow. But none of these can replace the internal authority that true traders develop. The trader identity is built on acceptance. Acceptance of uncertainty, loss, imperfection, and delay. This acceptance is not passive resignation. It's active engagement with reality, as it is, not as one wishes it to be. Without this acceptance, traders constantly fight the market, themselves, and time. They try to bend reality to their will, instead of aligning their will with reality. This friction creates chronic frustration, emotional burnout, and cognitive dissonance. Only when the identity shifts does this friction begin to dissolve. What makes this shift so difficult is that it requires emotional detachment without emotional numbness. The trader must care deeply about the process, while remaining indifferent to individual outcomes. This balance is unnatural to most people, because it contradicts societal conditioning. In ordinary life, emotional investment is seen as commitment. In trading, emotional investment in results is a liability. The trader must feel without reacting, care without clinging, and act without attachment. These are not behaviors one can simply adopt. They are expressions of a transformed identity. The lack of identity shift also affects how traders view failure. The old self sees failure as something to avoid, as proof of inadequacy. The trader identity sees failure as feedback, as data that informs adaptation. Without this new lens, each loss feels like a personal defeat rather than a natural cost of doing business. The trader who hasn't shifted identity will chase perfection, trying to eliminate all mistakes, and in doing so, will eliminate all growth. The pursuit of flawlessness is the ego's way of avoiding vulnerability. But in trading, vulnerability is essential. It's only through acknowledging fallibility that one learns to manage it. Identity shift is not an intellectual process, it's emotional reprogramming. It requires unlearning deeply rooted patterns, the need for control, the craving for validation, the fear of being wrong. It requires building a new sense of self that thrives in ambiguity, that finds comfort in discomfort, and that measures success not by money but by mastery of self. The trader who undergoes this transformation doesn't stop feeling fear or doubt. They simply stop identifying with it. The emotions arise, but they no longer define the self. The journey from old identity to new identity is the invisible work of trading psychology. It's not glamorous, not shareable, and not immediate. It happens quietly beneath the surface, through countless small decisions made in moments of emotional turbulence. Each time a trader chooses patience over impulse, process over outcome, or observation over reaction, the new identity strengthens. Over time, the old one fades. But for those unwilling to let the old self die, trading remains a battlefield of emotional contradictions, where success always feels just out of reach. There comes a phase in every trader's journey where progress appears to vanish, a long, silent plateau where nothing seems to move forward. Profits flatline, motivation fades, and the confidence that once fueled consistent practice begins to crumble under the weight of monotony. This stage, often misunderstood and deeply uncomfortable, is known as the plateau of perceived stagnation. It's the psychological desert between the enthusiasm of beginnings and the realization of mastery. Most traders mistake this period for failure, but in truth, it is the phase where real transformation takes root, beneath the surface, invisible to the impatient eye. When traders first begin, progress feels linear. Each new piece of knowledge produces visible improvement. Concepts like support, resistance, and trend lines make sense. Backtesting yields patterns that appear to work, and the first few wins validate the illusion of competence. The brain, conditioned by linear progress in other areas of life, assumes that trading will follow the same path, that consistent effort equals consistent improvement. But the markets do not conform to that rule. The deeper a trader goes, the more complex the relationship between skill and outcome becomes. Eventually, visible results slow down, even though internal growth continues. This slowdown creates cognitive dissonance, the painful feeling that effort is no longer paying off. The plateau is not the absence of progress. It is the incubation stage of mastery. Just as the body must rest after physical exertion to build muscle, the mind must consolidate after intense learning to build resilience. However, the human psyche interprets stillness as failure. Traders who are used to quick rewards become restless during this stage. They begin to doubt their methods, their discipline, and even their potential. The frustration doesn't come from the lack of progress itself, but from the inability to perceive progress in a measurable way. The plateau becomes a psychological mirror that exposes how deeply the trader's motivation depends on external validation rather than internal conviction. In this phase, the unconscious mind is doing most of the heavy lifting. Neural pathways responsible for emotional regulation, pattern recognition, and decision-making are being rewired through repetition and exposure. Yet because these changes happen below conscious awareness, they go unnoticed. The trader feels as though nothing is changing, but the mind is quietly adapting to handle more complexity with less emotional interference. The problem is that the conscious mind, addicted to proof, cannot tolerate uncertainty. It craves immediate evidence of growth. When it doesn't see any, it panics and looks for new stimuli, a new strategy, a new mentor, a new indicator. This constant shifting interrupts the internal integration process, preventing the very breakthrough that was about to emerge. The plateau of perceived stagnation is where many traders self-destruct. Their expectations collide with reality, and their emotional tolerance is tested more than ever. The mind, desperate for novelty, interprets the absence of excitement as a sign that something is wrong. This restlessness pushes traders into impulsive decisions, overtrading, system hopping, or abandoning what was actually working. The tragedy is that they often quit right before the curve of compounding skill starts to bend upward. What feels like stagnation is in truth the psychological adaptation phase necessary for sustainable growth. One of the most destructive aspects of this plateau is that it triggers self-comparison. Traders begin to measure their progress against others. They see peers celebrating wins, posting profits, or appearing confident, while they themselves feel stuck in invisible struggle. Social media amplifies this comparison, distorting reality and deepening the sense of inadequacy. The mind doesn't just want success, it wants confirmation that success is happening faster than everyone else's. When that need goes unmet, doubt transforms into despair. This comparison loop magnifies the emotional weight of the plateau, until the trader feels entirely alone, believing that everyone else is progressing while they are not. The plateau is also a battle against boredom, the psychological state that reveals the gap between desire and patience. The early stages of trading are filled with discovery and excitement, but mastery requires repetition. The same setups, the same journaling, the same risk management routines. The repetition that once felt purposeful now feels meaningless. The human mind resists monotony because it confuses familiarity with stagnation. In truth, mastery is built through boredom. Every repetitive act, every disciplined execution in the absence of excitement, strengthens neural discipline and emotional resilience. But since there is no immediate feedback to validate this growth, the trader interprets the boredom as evidence that nothing is working. The psychological pain of this stagnation often leads to what can be called mental drawdown. Just as accounts experience equity drawdowns, the mind experiences confidence drawdowns. During these periods, traders lose faith in their abilities, and begin to internalize the market's randomness as personal inadequacy. The inner dialogue turns negative. Maybe I'm not built for this. Maybe I'll never get consistent. These thoughts are not reflections of truth, but symptoms of emotional fatigue. The plateau doesn't destroy traders through losses. It destroys them through discouragement. The mind convinces them that the struggle is permanent, and in believing that, they stop showing up consistently, which ensures that stagnation becomes self-fulfilling. The plateau also challenges a trader's relationship with time. Modern life has conditioned people to expect rapid returns, from fast information to instant entertainment. Patience has become a forgotten skill. Trading, however, operates on delayed gratification. It rewards consistency over time, not intensity in the moment. The trader who cannot endure the slow, invisible phases of development remains trapped in short-term thinking. They measure progress in weeks instead of years, outcomes instead of processes. This short-term focus makes the plateau unbearable because it contradicts their internal timeline of success. The more they expect visible progress, the more frustrated they become when progress hides beneath the surface. At a neurological level, this frustration comes from dopamine imbalance. In the early stages of learning, every new discovery triggers a dopamine release, the neurotransmitter responsible for motivation and pleasure. But as the activity becomes familiar, dopamine levels drop. The absence of this chemical reinforcement feels like emotional flatness. Most traders misinterpret this natural neurological shift as loss of passion. They think they've lost interest or purpose, when in reality, their brain has simply adapted to the learning process. The key is to transition from dopamine-driven motivation, chasing excitement, to discipline-driven motivation, pursuing mastery. Without this transition, traders remain dependent on emotional highs to sustain their work, making them vulnerable to burnout. The plateau also exposes the deeper psychological truth that traders often avoid confronting, that their attachment to progress is really an attachment to identity. When they feel they are improving, they feel worthy. When they feel stagnant, they feel inadequate. Progress becomes a mirror for self-worth. This conditional relationship with the self makes stagnation unbearable. The mind whispers, "If I'm not improving, maybe I'm not good enough." This belief corrodes self-trust and turns what should be a temporary phase of consolidation into a long-term emotional prison. The trader begins to associate stillness with failure, when in reality, stillness is the necessary pause between breakthrough. The plateau of perceived stagnation also tests emotional endurance. Each day feels like a repetition of the last. No breakthroughs, no validation, no visible transformation. The challenge is not intellectual, it's emotional. Can the trader continue to act with discipline when there's no immediate reward? Can they hold faith in their process when the world gives them no reason to believe? This is where trading separates the motivated from the committed. Motivation is fueled by progress. Commitment is fueled by purpose. Only those who operate from a place of purpose endure the plateau without collapsing under its weight. Psychologically, the plateau reveals the hidden impatience within the human mind. Most people are addicted to progress because progress provides a sense of control. It gives the illusion that life is moving forward. But the plateau removes this illusion and forces the trader to confront the raw truth. They are not in control of the market, nor the timing of their own transformation. This realization is painful because it shatters the ego's narrative of mastery. The trader learns, often unwillingly, that the process of evolution cannot be rushed. Growth happens on its own timeline, not according to the trader's expectation. The plateau is not just mental, it's emotional restructuring. The trader's old relationship with progress, one based on visible results, must dissolve to make room for a new relationship based on trust. Trust in the process, trust in oneself, trust in the unseen accumulation of experience. This kind of trust cannot be learned intellectually, it must be earned through suffering. The boredom, frustration, and doubt of the plateau serve as emotional resistance training. Just as muscles grow by tearing and rebuilding, emotional resilience grows by enduring discomfort without surrendering to it. What makes this stage so misunderstood is that it feels exactly like regression. Trades that once worked stop working. Confidence that once felt natural becomes fragile. The trader begins to feel like they've forgotten everything they knew. But this regression is often a sign of integration. The mind is reorganizing information at a deeper level. refining intuition and detaching from superficial metrics of success. Just as a caterpillar dissolves completely before transforming into a butterfly, the trader's old mindset must disintegrate before the new one emerges. The chaos of stagnation is not decay, it's metamorphosis. During the plateau, traders are faced with a choice: to seek escape or to surrender to the process. Most choose escape because surrender feels like weakness. But surrender is not giving up. It's the acceptance of the natural rhythm of growth. It's the acknowledgement that not all progress is visible, that mastery unfolds in silence, and that patience is the bridge between effort and result. Those who resist the plateau spend years circling back to it, never realizing that the way out was always through. The plateau of perceived stagnation is the crucible where traders are stripped of illusions: the illusion of control, the illusion of speed, and the illusion of linear progress. What remains after these illusions burn away is the raw essence of discipline. This stage doesn't test skill, it tests faith. It asks a simple but profound question: can you keep walking when the path feels invisible? Most cannot, not because they lack knowledge, but because they lack the psychological endurance to operate without constant reassurance. Those who stay long enough to internalize the lesson of the plateau eventually understand that stagnation is not the absence of growth, but the gestation of transformation, quietly preparing them for the next level of evolution that the impatient never reach. In the world of trading, most people obsess over financial capital, the size of their account, their leverage, and their potential returns. They track every loss, every gain, every percentage change, as if those numbers define their worth. But what truly determines a trader's survival is not their money, it's their psychological capital, the reservoir of emotional stability, mental clarity, and resilience that allows them to think clearly under pressure. This unseen capital is finite, yet most traders treat it as if it's infinite. They deplete it trade after trade, day after day, without replenishment, until the mind collapses long before the account ever does. Mismanagement of psychological capital is the silent killer of trading careers, the unseen force that causes burnout, self-sabotage, and ultimately surrender. Psychological capital can be understood as the energy that fuels decision-making. Every choice, every risk, every emotional reaction draws from it. Unlike financial capital, which is visible and measurable, psychological capital drains quietly. A single trade may cost very little money, but can cost immense psychological energy if it's emotionally charged. The stress of uncertainty, the fear of being wrong, the frustration of missed opportunities, all of these consume mental bandwidth. Over time, this depletion accumulates, and even the most skilled traders begin to make poor decisions, not because they lack strategy, but because their minds are fatigued. The most dangerous losses are not financial, but psychological. They're the invisible debts the trader owes to their own nervous system. In the early stages of trading, most individuals underestimate how emotionally expensive the process is. They believe the main challenge lies in mastering systems, charts, and analysis. But every chart pattern, every indicator, every plan exists in theory until it's tested under emotional pressure. That's when the real cost emerges. Every time a trader hesitates, every time they overthink, every time they watch price move against them, the brain is burning energy trying to reconcile conflicting impulses, fear of loss and hope for gain. This constant internal tug-of-war is not sustainable without rest, reflection, or recovery. Yet because the trader's focus is external, on performance metrics, they never realize how rapidly their psychological capital is eroding beneath the surface. One of the primary causes of psychological capital depletion is emotional overexposure. Trading places the mind in constant contact with uncertainty. Unlike other professions, where effort correlates with outcome, trading delivers randomness in the short term. You can do everything right and still lose. Each of these losses registers as micro-trauma, small psychological cuts that over time weaken the emotional immune system. Without recovery, these cuts accumulate into deep wounds. The trader begins to experience irritability, anxiety, and detachment. Their decisions become reactive rather than deliberate. They start breaking rules, not because they want to, but because their emotional bandwidth has run out. Another major drain on psychological capital is mental clutter. The modern trading environment bombards individuals with information, multiple screens, endless market news, constant social media analysis. The brain, wired for survival and pattern recognition, tries to process it all, searching for control in chaos. But the more data it absorbs, the more confused it becomes. This overload doesn't enhance performance, it paralyzes it. Mental clutter consumes focus, leaving little room for composure. Over time, decision fatigue sets in. The trader becomes mentally exhausted before the session even begins. When the mind is tired, discipline disappears, and impulsive behavior takes its place. The depletion of psychological capital manifests not as a lack of intelligence, but as the loss of inner stillness. The mismanagement of psychological capital is also deeply connected to the emotional intensity of attachment. Many traders tie their self-worth to the outcome of trades. Each win inflates their ego. Each loss deflates. This constant emotional oscillation drains enormous energy because the trader is not just managing trades. They are managing their identity through the trades. The brain interprets every loss as a personal attack, triggering stress responses that were meant for physical danger. Adrenaline and cortisol surge, heart rate increases, and rationality fades. Each of these physiological reactions extract psychological cost. When the mind is in a constant state of threat perception, it loses its ability to see clearly. What began as a skill-based pursuit becomes an emotional survival game. Psychological capital also depletes through lack of detachment. Traders who cannot emotionally separate themselves from outcomes end up reliving their losses long after they occur. They replay mistakes, question decisions, and mentally punish themselves for being wrong. This self-criticism creates internal friction that drains motivation. The mind becomes its own adversary, constantly reliving emotional pain instead of processing it. Over time, this habit builds chronic stress, a silent erosion of psychological resources. The trader wakes up each day with less energy to think objectively. Their patience shortens, their confidence wanes, and their tolerance for uncertainty collapses. Another hidden form of mismanagement is revenge trading, a behavior rooted not in strategy but in depleted psychological energy. When a trader loses emotional control, the mind seeks relief from pain through action. The urge to make it back is not logical. It's a desperate attempt to restore internal balance. But acting from emotional exhaustion only deepens the damage. Every impulsive trade taken from frustration compounds the psychological debt. Over time, this cycle becomes a pattern of self-destruction, where the trader no longer trades to win, but to feel temporary relief from the discomfort of loss. Unlike financial capital, psychological capital cannot be replenished through external means. It doesn't return with a winning streak or a new strategy. It requires intentional recovery, practices that restore clarity, composure, and self-awareness. Unfortunately, most traders resist recovery because it feels unproductive. The same drive that fuels ambition blinds them to the necessity of rest. They believe that taking breaks, journaling emotions, or stepping away from charts is a sign of weakness. This misunderstanding transforms discipline into obsession. They grind harder, analyze more, and push through exhaustion, unaware that every extra hour spent under tension diminishes cognitive function. The brain is like a battery. Without recharge, it cannot sustain precision. One of the most overlooked drains on psychological capital is uncertainty intolerance. The inability to sit with ambiguity, to watch a trade fluctuate without reacting, exhausts emotional resources. The constant need to control outcomes, to monitor every tick, and to find meaning in randomness is mentally draining. This behavior stems from the illusion that certainty can be achieved through observation. In reality, the more one watches, the more emotionally entangled they become. The trader's mind begins to interpret every small move as a threat, keeping the nervous system in perpetual alertness. This hypervigilance slowly depletes the mind's reserves, making rational decision-making impossible over time. The mismanagement of psychological capital often reveals itself through emotional exhaustion disguised as apathy. Traders reach a point where they stop caring, not because they have transcended emotion, but because they are burned out. Their emotional circuits have been overloaded for so long that numbness replaces engagement. This detachment is deceptive. It feels like calm, but it's actually depletion. The mind has simply shut down to TED itself. In this state, performance deteriorates silently. The trader makes careless mistakes, misses obvious setups, or exits trades prematurely, not out of fear but from emotional fatigue. The cumulative effect of this mismanagement is the erosion of self-trust. Each time a trader breaks a rule over trades, or acts impulsively, they lose a bit of trust in their own decision-making. This self-betrayal corrodes confidence, which is the foundation of psychological capital. Confidence is not arrogance. It's the inner belief that one can remain stable under pressure. When this belief weakens, every trade becomes a source of anxiety. The trader starts second-guessing their judgment, entering trades with hesitation and exiting them with regret. The mind becomes fragmented, torn between analysis and emotion, unable to operate cohesively. A key insight about psychological capital is that it is non-linear. Just like compounding losses can accelerate financial ruin, compounding stress accelerates mental exhaustion. The first few instances of emotional strain may go unnoticed, but over time, they accumulate exponentially. The mind's resilience weakens, reaction time slows, and perspective narrows. What used to be minor inconveniences become major emotional triggers. A small drawdown that once felt manageable now feels unbearable. The trader becomes hypersensitive to volatility, interpreting normal market fluctuations as personal threats. The erosion of psychological capital transforms even stable traders into erratic ones. Replenishing psychological capital requires awareness and intentional detachment. It begins with recognizing that emotional energy is as valuable as money. Each decision must be evaluated not just by its potential reward, but by its emotional cost. The best traders are not those who make the most trades. They are those who preserve their psychological capital by conserving energy. They understand that discipline is not about doing more, but about doing less, with precision. They protect their focus as fiercely as they protect their capital. They limit exposure to noise, avoid unnecessary trades, and maintain routines that stabilize the mind. Exercise, mindfulness, journaling, or time away from screens. However, most traders never reach this understanding because they confuse exhaustion with dedication. They glorify the grind, the endless chart watching, sleepless nights, and emotional overexertion as signs of commitment. In reality, these behaviors are symptoms of imbalance. The market rewards clarity, not exhaustion. When the mind is overworked, perception distorts, bias takes over, fear amplifies, and confidence evaporates. What follows is a cascade of emotional errors that no amount of technical skill can fix. The mismanagement of psychological capital also reveals the deeper human need for certainty, validation, and control. Traders unconsciously try to use the market to meet emotional needs that have nothing to do with trading. The need to feel competent, the need to feel safe, the need to feel in control of life's unpredictability. When the market denies these needs, the trader experiences emotional withdrawal similar to addiction. They chase the next winning trade, not for profit, but for psychological relief. This unconscious dependence consumes enormous emotional energy, leaving the trader mentally drained even on profitable days. One of the greatest misconceptions in trading psychology is that discipline alone is enough. Discipline is critical, but it cannot exist in isolation from emotional well-being. A disciplined mind without energy is brittle. It breaks under prolonged stress. The real foundation of consistency is emotional sustainability, the ability to operate effectively day after day without emotional depletion. This requires balance, periods of focus followed by rest, periods of analysis followed by reflection, exposure to pressure followed by recovery. Just as professional athletes manage physical recovery as carefully as performance, traders must manage emotional recovery with equal precision. Another way psychological capital is mismanaged is through constant self-evaluation. Traders spend hours judging themselves, dissecting every mistake, comparing every result, criticizing every decision. While reflection is valuable, excessive self-judgment corrodes confidence. The mind becomes hostile territory, a place of punishment rather than growth. Over time, trading stops being an act of exploration and becomes an act of self-defense. The trader operates from fear of failure instead of curiosity about improvement. This internal hostility drains energy faster than any losing streak. Ultimately, The mismanagement of psychological capital leads to an internal imbalance where emotional depletion becomes the baseline. The trader no longer operates from clarity, but from survival. Every trade becomes an attempt to fill an emotional void rather than execute a plan. The more they trade, the more exhausted they become, and the more exhausted they become, the less capable they are of rational thought. This spiral continues until the trader either breaks down mentally or steps away, not because of financial ruin, but because of emotional bankruptcy. Psychological capital is the invisible currency of longevity. It determines how long a trader can remain objective amid chaos, how deeply they can endure losses without losing focus, and how calmly they can wait for the right opportunities without succumbing to impatience. The traders who last are not those who never get emotional, but those who manage their emotional energy as carefully as they manage their money. They know when to step back, when to rest, and when to reset. They treat their mind as an asset, not a weapon. For those who fail to recognize this truth, the market will always find a way to expose their imbalance, not through sudden catastrophe, but through the slow erosion of psychological capital, until nothing remains to keep them in the game. Endurance in trading is not about surviving the market. It is about surviving oneself. It's not the candles, the volatility, or the random news spikes that destroy most traders. It's the inability to emotionally and psychologically endure the slow, grinding process of becoming consistent. The mind that seeks speed and certainty collapses under the weight of slow uncertainty. Endurance, therefore, is not just persistence. It's the transformation of one's relationship with time, pain, and self-belief. It is the evolution from chasing outcomes to embracing process, from reacting to adapting, and from fighting the market to flowing with it. The psychological structure of endurance begins with the ability to detach one's sense of self from short-term results. This is where almost everyone fails. The trader ties identity to outcomes. A good day means I'm talented, a bad day means I'm failing. Each trade becomes a referendum on worth, and each fluctuation feels personal. This attachment drains emotional energy and shortens endurance, because every loss feels like identity death. True endurance starts the moment a trader can lose without losing themselves. It's the shift from self-validation through outcomes to self-validation through discipline. The foundation of endurance is emotional flexibility. The market changes constantly, and the trader's internal world must be able to adapt to those changes without breaking. Rigidity is the enemy of endurance. The trader who insists on being right cannot last long. The one who adapts to being wrong without shame can survive indefinitely. Emotional flexibility means understanding that setbacks are not final, that pain is part of progress, and that resilience is not about avoiding emotion, but managing it. It's about feeling fear and still acting logically, about feeling doubt and still following the plan. Endurance also depends on energy conservation, not just physical but psychological energy. Every thought, every worry, every internal argument consumes energy that could have been used for decision-making. The traders who endure are not those who fight the market hardest. They are those who conserve their emotional capital best. They know when to rest, when to pause, and when to protect their focus. They understand that recovery is part of the game. A trader who refuses rest will eventually confuse exhaustion with dedication, mistaking mental burnout for hard work. True endurance is a quiet discipline, a balance between intensity and patience, action and reflection. There is a profound loneliness in the path of endurance. Trading isolates people from the collective rhythm of ordinary life. There are no coworkers to share frustration, no bosses to give validation, and no applause for discipline. This solitude can feel unbearable to those who haven't made peace with themselves. The trader who endures is one who finds stillness in solitude, who turns isolation into introspection. In the silence of this process, the market becomes less of an opponent and more of a mirror, reflecting back the trader's mental state, emotional imbalances, and inner contradictions. Endurance requires facing these reflections without flinching, without running back to distraction or denial. What makes endurance so difficult is that progress in trading is often invisible. It's not like other fields where improvement is measurable through recognition or advancement. In trading, progress hides beneath consistency, beneath boredom, beneath the quiet mastery of execution, without emotion. The The trader who endures must develop faith, not blind optimism, but rational trust, that small unseen improvements will eventually manifest. This kind of faith cannot be taught by strategy books or trading mentors. It comes from lived experience, from surviving countless emotional storms, and discovering that the mind is stronger than the market's chaos. Endurance also means learning how to coexist with imperfection. The mind loves to imagine a state of mastery where emotions no longer interfere, where discipline is effortless, where every trade aligns perfectly with the plan. That fantasy is an illusion. No matter how long one trades, fear, greed, and hesitation never fully disappear. What changes is the relationship to them. The enduring trader doesn't try to eliminate emotion. They learn to observe it without identification. They learn to coexist with uncertainty without reacting to it. They become less concerned with controlling the market and more focused on controlling their state within it. There's a psychological paradox embedded in endurance. The more you try to endure through force, the faster you burn out. True endurance doesn't come from aggression or stubbornness. It comes from surrender. Not surrender as defeat, but surrender as acceptance. Acceptance that losses are part of the process, that discomfort is unavoidable, and that patience is not weakness but strength. The ego wants control. Endurance requires letting go. The trader must learn to coexist with what cannot be predicted. To accept that mastery is not the absence of pain, but the ability to function effectively in its presence. Endurance is also built through cycles of doubt and renewal. Every trader who lasts long enough faces moments where quitting feels rational. The losses accumulate, confidence fades, and fatigue clouds every thought. These moments are not signs of failure, they are thresholds. The mind reaches a point where its old coping mechanisms no longer work, forcing the trader to evolve. In these moments of psychological collapse, a new level of understanding emerges, that success is not about avoiding breakdowns, but learning how to rebuild faster each time they happen. Each emotional crash, each moment of despair, forges deeper resilience. What many fail to see is that endurance is not linear. It comes in waves. There are times when everything flows easily, and confidence feels unshakable, followed by periods of confusion and regression. This cyclical nature is part of growth. The market is dynamic, and the trader's internal world must mirror that rhythm. The enduring trader learns to flow with the cycles, to act decisively in clarity, and to retreat into reflection during confusion. They no longer measure success by how consistently they win, but by how quickly they regain balance after being thrown off. Endurance, at its deepest level, is a spiritual concept disguised as a psychological one. It demands humility, the recognition that one's control over outcomes is limited, that intelligence doesn't guarantee success, and that the market is always bigger than the ego. This humility doesn't come easily. It's learned through repeated defeat. Every loss chisels away at arrogance. Every setback dismantles illusion, and every period of stagnation humbles the mind until what remains is clarity. The trader who has endured long enough no longer trades for validation or escape. They trade from a place of stillness, an inner calm forged by suffering and persistence. The endurance mindset transforms the way traders experience pain. Instead of viewing losses as punishments, they see them as feedback. Instead of interpreting drawdowns as personal failure, they understand them as part of statistical probability. This shift is not merely intellectual, but emotional. It takes years of emotional conditioning to stop internalizing losses as personal attacks. The mind must evolve beyond ego-based thinking to process pain with neutrality. That neutrality is what separates the fragile from the resilient. Traders who endure long enough begin to operate with what psychologists call quiet confidence. It's not arrogance, nor is it blind faith. It's an inner knowing that no single event can define them, no loss can destroy them, and no moment of doubt can derail them permanently. This quiet confidence is the ultimate byproduct of endurance. It allows the trader to face chaos with calmness, to make decisions from clarity rather than desperation, and to maintain balance even when everything feels uncertain. The psychology of endurance also reveals a deeper truth about human behavior, that most people don't fail because they lack talent or intelligence, but because they cannot sustain emotional stability through long periods of ambiguity. Endurance is the rarest psychological trait, because it demands consistent strength in the absence of reward. It requires faith when results are invisible, patience when progress feels stagnant, and composure when everything screams to give up. The few who master endurance understand that consistency is not a matter of strategy, but of emotional regulation, the ability to stay grounded no matter what happens externally. The enduring trader is not fearless, but fear-aware. They know that fear will always whisper, fear of loss, fear of missing out, fear of being wrong. But they also know that fear, when observed rather than obeyed, loses its power. Endurance doesn't eliminate fear, it integrates it into awareness. The trader learns to act despite fear, to trust their preparation, and to move forward even when the outcome is uncertain. This calm persistence, this steady execution in the face of internal noise, is the essence of endurance. The deeper irony of endurance is that it cannot be taught through theory. It must be lived. It must be felt through failure, fatigue, and frustration. It is the invisible bridge between learning and mastery, between strategy and wisdom. Every great trader, at some point, reached a breaking point, not financially, but psychologically. What separated them from those who gave up was not knowledge, but endurance. They stayed. They adjusted. They adapted. They kept showing up long after motivation disappeared. Through that continued presence, their psychology evolved beyond emotion and expectation, into awareness and detachment. Endurance is what transforms trading from a pursuit of money into a practice of self-mastery. Each moment of doubt becomes a lesson in patience. Each failure becomes a mirror of attachment. Each small victory becomes a reminder that progress exists even in silence. The trader who endures long enough stops seeking success and starts embodying it. Not as a destination, but as a state of being. The market no longer dictates their emotions because they've outgrown the need for reassurance. Their stability is internal, their validation self-sustained, and their calmness unshaken by chaos. In the end, every trader faces the same choice: to chase or to cultivate. To chase results, emotions, and illusions of control, or to cultivate patience, awareness, and endurance. Those who chase find excitement but burn out quickly. Those who cultivate find mastery but must walk through long periods of uncertainty to reach it. Trading in its truest form is not a game of intellect, but of psychological evolution. It demands the breakdown of every illusion the mind clings to. The illusion of quick success, the illusion of control, the illusion that more knowledge guarantees better results. It strips the trader of comfort until only truth remains. The greatest traders are not born from talent. They are forged through suffering. Each phase of their journey dismantles a layer of ego. The illusion of speed dissolves into the patience of process. The volatility of emotion transforms into the stillness of observation. The craving for certainty gives way to acceptance of randomness. What remains after these transformations is not just a trader, but a different kind of human being. One who understands that mastery over markets begins with mastery over the self. The psychological game of trading is the mirror of human nature. Every strength and weakness, every fear and desire, every illusion and truth, they all surface in the arena of uncertainty. The market doesn't punish or reward. It simply reveals. It exposes impatience, amplifies ego, and magnifies self-deception until the trader either breaks or transforms. Those who endure long enough to face their own reflection without denial discover that the true opponent was never the market. It was always their own untrained mind. Psychological capital, emotional endurance, and identity transformation become the real assets of a trader who survives the long journey. Money may fluctuate, but character compounds. When all illusions fade, what remains is awareness, the quiet understanding that trading is less about predicting the future and more about managing the present. The mind that can stay still in uncertainty, detached in loss, and disciplined in chaos, becomes unstoppable. Not because it conquers the market, but because it no longer needs to. And so, trading becomes not merely an act of speculation, but a form of self-realization. Each chart, each loss, each decision becomes a reflection of consciousness itself, a reminder that success is not the absence of failure, but the mastery of response. The trader who learns this truth transcends the cycle of giving up before success arrives, because they understand that success isn't a single event waiting at the end of struggle. It's the transformation that occurs within the struggle itself.